make money long term by being a stock market investor, it's absolutely critical that you're able to keep your cool in months like October of 2018, or if and when we hit the next bear market. Now, I focus on the next bear market. A bear market is a drop of 20% or more in the stock market. Very painful. It tends to coincide with a recession, and they tend to last about a year and a half. So that's month after month after month for a year and a half, where it doesn't seem like it's getting any better. You know, the news continues to get worse, and some point in the future it's going to turn around. Now the problem is, if you go back to 2008, 2009, when we had the financial crisis, the market bottomed in March of 2009. At that time, unemployment was still getting worse. You know, every day you're hearing headlines about how the world's financial system is still on its knees, and the world still seems to be coming to an end. But yes, lo and behold, in March of 2009, when nobody expected it to, the market bottomed and started a long upward march. It's been tremendous over the last 10 years or so. The Great Recession of 2008-2009 was fueled by debt. It was driven by debt, and chances are the next time we go into a recession, it's going to be more of what we would call a garden variety recession, where it's not as deep, is not as long, because it's not driven by the same factors that really drove the market down so much in the last downturn. The other thing I want to encourage you with is, if you look at your portfolio today, let's say you are 58 years old today, you want to retire, transition out of full-time work in the next few years. Okay, so if you go back 10 years, you were 48 10 years ago. Hopefully your portfolio, when it dropped in the 2008-2009 financial crisis, it looked a lot different than it looks today. When you were 48, you were much further from retirement. So hopefully you are also more conservative today and less prone to a deep or prolonged downturn in the market. So those are a couple of areas I just want you to think about as we potentially head into another bear market and another recession, because it's not a matter of if, it's a matter of when, and we have to plan for it and prepare for it if we expect to keep our cool. So this strategy is called the bucket strategy, and here's how it works. You put away 18 months worth of living expenses. Now, you have to know what you're spending every month, but let's say you know exactly what you're spending every month. And whatever amount that is that you would normally draw out of your investment portfolio for that 18 months, you set that aside into a cash or a cash-like bucket. And so it doesn't have to be in cash. In fact, money markets right now, which are a cash-like investment, they pay about 2%. You could buy CDs, which are FDIC insured. The rest of your portfolio over here can remain invested, and it doesn't matter so much if it goes up and down, because you are not relying on it for that particular time period to provide for your monthly living expenses. So why do I use 18 months? Well, actually, this is a really important point, and it's not arbitrary at all. If you go back over the last several decades, there have been quite a few bear markets, a drop of 20% or more, and quite a few recessions to go alongside that. The average bear market lasts for 17 months. And even if you go back to 2008, 2009, that bear market lasted about 18 months. So, you know, even in a really ugly time period, chances are, even if you have this set aside in cash, you're not going to need to draw from your portfolio, and you are much more likely to keep your cool if you know that you have cash set aside to cover your living costs and kind of shore things up during that difficult time period. And now I'm going to talk about strategy number 2, which is what I call the 5% rule. This is something that we have used with our clients for many, many years. We used it with our clients before I ever came around, and it works really, really well in good markets and bad markets. If you follow the strategy of the 5% rule, it takes out the emotional temptation and it actually forces you to buy low and sell high. How the 5% rule works is if your asset allocation or your mix of stocks and bonds gets out of balance by 5% or more from where you should be ideally, then what we do is we get you back up to where you should be. So if you go from 60% stocks to 55% in stocks, then we would take money from the bond side of the equation, move it back into stocks to get you back to where you should be. Strategy number 3. All right, so the third and final strategy to keep your cool in a down market. This one's a little bit more complex, so I'm gonna ask you to just stick with me through this. I'm gonna try to explain it the best way I can. This strategy is called tax loss harvesting. That's how it works. You can sell, you would never do this in an IRA because it doesn't make sense, but if you own a position like this in a taxable account, it's underwater, it's worth less today than what you paid for it, you can sell it. So you would sell it for $8,000. Now you have, because you paid $10,000, you have a loss on that investment of $2,000. You get to report that loss on your taxes and it helps you offset gains. It basically helps with your tax situation. So you get to benefit from that today by realizing that loss or harvesting the loss. Now, you don't have to stay out of ABC stock forever. Let's say ABC stock is a really great investment long term, you still believe in it, but you really wanted to take advantage of that loss, and that's fine. All you have to do is stay out of that investment for about a month, and then you can buy back the stock a month later after you sell it and continue to own it just like you did before. But instead of paying $10,000, let's say you buy it for $8,000 when you buy it back, and hopefully it does better for you in the future than it did during the time frame that you owned it. Many investors, because the market has been so good over the last several years, haven't been able to use tax loss harvesting as a strategy, but it's a strategy that works really well in down markets. It can help lower your taxes this year. It can help you sell investments that you maybe paid too much for when markets were good, and then buy them back at a lower value if they've gone down in value today. Those are the 3 tips: the bucket strategy, the 5% rule, and tax loss harvesting. These are all ways that you can keep your cool in a bear market. Thank you so much for watching. If you like this video, give us a thumbs up. If you have questions or comments, please leave them in the comment section below this video. My name is Ashley Micciche, and I hope to see you next time. Hopefully I'll see you next time. Oh, that was so corny.